Thank you, everybody, for joining. So I'm just going to spend a couple of minutes talking about what Cerillion does, who we are, etc. For those of you who don't know the company or haven't heard from us before, I'll keep this brief because I appreciate that a lot of you know the company and have heard from us before. Essentially, Cerillion provides what we call BSS, OSS software to the global telecoms market, to telcos all around the world, and that is to about 70 customers in, I think, 40 countries. So what is BSS and OSS? Essentially, BSS and OSS software is the enterprise software that sits between telecoms businesses, network infrastructure, and their customers. So it's the software that enables telcos to monetize those network assets. And that involves, for example, defining the products that their customers are sold, onboarding those customers either through CRM or through customer self-service or through mobile apps. Once those customers are onboarded, connecting those customers' services to the network that they're going to use. Once those customers are using those services, then charging for those services, managing that usage, putting it onto bills, handling payments, receivables, collections, etc. And we do this through a suite of modules that fit into the sort of industry-defined space that this software sits in. And we sell that basically as a service basis. So our customers subscribe to use our software, typically for 5-year term agreements. Part of the deployment is quite a large services project to implement the solution. These are complex solutions, and even though we are much quicker at this than the competition, they still take 12 months, sometimes 18 months or so to deploy. So that can be a significant piece of services work, and that's treated as a separate project and a separate deliverable, recognized on a milestone completion basis, as opposed to the different recognition we use with the subscription side of the deal. Just very quickly, in terms of how we differentiate, so we're in a market where most of the competition is much larger than us, and most of the competition is focused on a much more services heavy, bespoke oriented solution. So our main competitors are all delivering much more tailored solutions that take longer to deploy and have a higher long-term total cost of ownership, and essentially are less flexible, because as opposed to our solution, which is a product which is designed to be used by all customers, regardless of whether they're mobile, broadband, TV, satellite, whatever. We have a one-size-fits-all model. The software works out of the box on day one, and all customers use the same software, giving them a very clear upgrade path going forward. So that's a differentiator for us in the market, and that's our main USP. This is a huge market. These are figures from IDC. It's not a very fast-growing market, growing around 4% a year, but it's expected to grow to $60 billion a year in 2029. So, given the revenues we're reporting, if we only have a fraction of this market, we're still going to easily achieve our broadest ambition. So this is an enormous market. And another thing to say about it is that telcos work the same the world over. It's a truly globalized business. The way that we interact with telecom networks in the UK or in France or Germany is the same as it's done in the US or in Asia, in Japan or China or whatever. So, and we're also interfacing to the same equipment in all these different places. So we are able to embrace customers, from Armenia, one of the wins we announced in 25, through to North America, through to France or whatever. It's a truly global business. So just looking at the highlights of the year. So we had a good year from a trading point of view. We achieved new highs across all the key financial measures, but we're particularly pleased about total new orders, which were up 25% to around 48 million. And that pushed up our back order by 21% to a new record level. And we'll talk more about that later on. EBITDA margins in general were up quite significantly again. And we'll talk about that in more detail. And we'll also talk about the cash generation, which was also strong. But in terms of the new order figure, a couple of points to make here. Within this 48 million number, there were two significant individual deals. One was the $11.4 million contract we won with Ucom, which is one of the national telcos in Armenia. So supporting a full range of services with that telco. But this is interesting because it's a new customer with a new geography, a new market. And I think this is a part of the world, the Caucasus, where there are a lot of booming economies because of natural resource wealth. There are some quite big populations which together sustain some larger telcos. And Armenia is a bit of a minnow in this part of the world. It's one of the smaller countries. Um, but that's a foothold into that region, and we have prospects in our pipeline that are much bigger than this deal was. And now we have that reference. I think we can do more in that region. And these aren't necessarily the household names of the Vodafones and the AT&Ts, but they're still can generate very large deals. And the other deal that I want to talk about was a deal we won with an existing European customer, which has acquired one of the mobile operators in its home market. And this expansion, £25 million deal, largest we've ever signed, is to migrate that mobile customer base onto the existing customer's existing Cerillion platform. And that involves not just services, but license expansions, managed service expansions, and so on. So essentially, expansion of the subscription agreements. So that was a really interesting example of how a existing customer can drive significant upsell. And I think this is a theme in our development, that the more of these larger customers we sign, the greater propensity those customers have to generate more revenue, and that becomes a self-perpetuating growth cycle. The final point on the orders is that out of 48 million of orders, only $11.4 million, or about around £8 million, was with a new logo. So nearly £40 million of that 48 was with existing customers. So again, strength of the customer base, particularly as we start winning larger customers, is key to growth going forward. Because of our confidence in not just in the order book that we've achieved in 25, but our confidence in the pipeline going forward, we've increased the dividend by 17%, which is higher than the top line revenue growth, but that reflects that confidence. And the fact that we do feel we're very well positioned to achieve the 26 numbers, and our guidance to the analysts has been to maintain 26 consensus. We're very confident that's all possible. Moving on to some operational highlights. We completed 2 new implementation projects in 25. First of these was Virgin Media in Ireland. So Virgin Media, very interesting for us, and it's worth a couple of minutes on this. So this is really a tier 1 implementation environment, and quite different in many ways to the environments we worked in the past, in that this involved working with a major systems integrator, a company called Infosys, one of the world's biggest, and they are present in a lot of the world's largest telcos, so very influential. And essentially, we provided our software with our industry standard APIs, and the integrator Infosys, with a team of about 70 people, did most of the upstream and downstream integration themselves. Now, it's important for 2 reasons. One is that we have a proof point, and we can work in these big tier 1 environments that are much more complex and involve other parties. But also within Infosys, that they were able to do that work relatively seamlessly without much support from us, and deploy a team of 70 people onto that job. So for them, they can see that working with Cerillion, they get to lots of services work and make lots of money. Whereas if they were working with some of our more services-heavy, services-focused competitors, they would get a lot less of the services work. So that I think is an important project to have been involved in. We also completed the project in Southern Africa with Paratus. So Paratus were a completely different kind of customer. They're a growth business. They have a territory covering 7 Southern African countries, South Africa, Namibia, Botswana, and so on and so on. And they provide satellite communications, they provide broadband to business, and have just launched a terrestrial mobile network in Namibia, which was what triggered the need for a new platform, because the existing stuff they had would not support mobile. So that gave us a foot in the door. So we've implemented Namibia. We're now looking to roll this out with them to other territories as time goes on. On the operational side, we've also invested quite a lot in 25. So we've expanded the sales team, bringing in some heavy hitters from the competition, some people with lots of experience to help us try to better access some of these larger telcos. And these are quite expensive resources, but what we're targeting is people coming from competitors who have networks, who know customers that could be contacted and might be prized away, and essentially come with some level of pipeline. And we've seen this work quite powerfully. For example, this was how we won that deal we were talking about earlier in Armenia. Also, there's been a lot of investment into R&D. So we increased R&D investment by about 30% in 25, and that generated 17,500 or so man days of work, or the equivalent of a team of 80 people working constantly just on R&D. A lot of the focus has been around AI recently. Last year, we were doing AI work around helping our customer staff to be more efficient, This year, the focus has been much more on enabling better customer service and more efficient customer service to our customers, particularly through agentic AI and the use of things like build query agents and so on that do the work of a customer service person, but much more effectively, much faster, and without the person. So you have a cost saving and a better service. Also, we've been working on creating a much more flexible environment in which our customers can use AI to make it easy for them to use either our AI agents or other AI agents provided by other third parties or things they want to build themselves. And also be able to work with any of the LLMs, the language models that are out there. And there's interesting article from our product manager, which is out on the website today on this particular area. It's a rapidly evolving space, and what we're doing is trying to build as much flexibility and future-proofing as we possibly can, so that we can offer real product solutions to our customers rather than a services-heavy bespoke play in each scenario. Finally, for me, a few words on the competitive landscape. There have been some changes in our competitive landscape in the last year. So one particularly important change is that our number 2 competitor, a company called Netcracker, which is owned by NEC, the Japanese conglomerate, they're buying our number 3 competitor, CSG, from the US. So that's very positive in that not only does it take one of the top 3 competitors out of the market, so when it comes to tenders, the top 3 are now the top 2, so obviously it's easy for us to compete, but also the fact that CSG have been absorbed into Netcracker means that a lot of the CSG customers will be assuming that product line's end of life and wondering what the future is. And Netcracker is an expensive organization. It costs a lot of money to own that solution. They not all want to move on to that solution. And we'll start looking at other options. So that opens up a whole load of new prospecting for us. And it also puts people on the market. So we're already receiving CVs from people who are not looking forward to being part of the NEC Netcracker world. Another smaller competitor, a company called Optiva, recent announcement last few weeks that they're going to be acquired by another smaller player in Finland. So that takes a company that, to be fair, is much smaller and has been languishing for a long period of time. But there's now another base of customers that will be even more disgruntled, some of which are already in our pipeline. Others will enter it, I'm sure. So those are quite interesting changes. So I'm going to hand over now to Andrew, conscious of time. He'll talk about the numbers in some more detail.
Great, thank you very much, Lou. So as you can see, 2025 was another year of very strong financial performance, with all key metrics up at record levels. Revenue increased by 4%, up to £45.4 million. And over the last 5-year period, the compound annual growth rate has been 17%. At the same time, adjusted PBT grew by 10%, up to £21.8 million. Part of the reason for the very strong growth in the year was a proportion of higher license revenue. So, as I think most of you are aware, any incremental license revenue drops through to profit at 100%. So that's very beneficial when it comes to supporting profit and the margin. We also saw an increase in the services day rate, and we talked about this at the first half results, and this strong increase again continued in the second half of the year and was again very beneficial for overall profit. So this has meant that the adjusted EBITDA margin increased by 3.5 percentage points, up to 50.9% for the year. So this is very strong financial performance. If you see, the margin over the past 3 years has been above 45%, which is very good for us to see. I think going forward into 2026, the analyst consensus is still at 45%. And whilst performance has been very strong over the past few years from a margin perspective, we are flagging that it could potentially be a little bit lower in 2026. For example, if the license mix changes, and that could be that if services revenue could grow faster than license revenue in 26, which could lead to a slightly unfavourable mix impact. Secondly, in 2025, we have benefited to a small degree from favourable FX. So, it was about 1 percentage point on the margin. So clearly, we can't benefit from favourable FX in every future period. So it could be, it could move against us in future periods. And finally, we have been investing very heavily, both in recruiting new sales heads. So there was a net increase of 5 sales heads in 2025. And we're expecting a similar increase again in 2026. So these are expensive people, and there can be a gap between making the initial investment and seeing the return come through. But we do believe, given the strong growth we see in the market, we do believe it is the right thing to invest in the sales force in order to make sure that we can deliver on our potential. At the same time, we have been recruiting more expensive delivery heads. So as we win these larger, more complex projects, we need to make sure that we've got the right people in place to retain the high quality of the work that we are undertaking. In terms of recurring revenue, the graph at the bottom left-hand corner, the dark blue graphs reflect recurring revenue that has been reported in the financial year. So this is made up of support and maintenance, managed service, and third-party hardware and hosting revenue. For the first time this year, on top of that, we have also given an annualized term license impact. So although our revenue recognition policy is to recognize license revenue up front for the full term when it's available for use, the metric in the light blue here shows a proxy for recurring annualized license revenue. So effectively taking the total revenue by customer over the full contract term and dividing that by the term length. And I think the key point here is you can see that has grown very strongly over the past 5 years. So this total recurring revenue metric has been growing at 21% on a compound annual growth basis, which is higher than the 17% increase for revenue. You can see cash increased strongly, again up to £34.4 million, and I'll talk about that in a bit more detail on the future slide. And this has enabled us to increase the dividend, so the dividend for the total dividend for the year up 17% to 15.4 pence per share. So in terms of the financial highlights, you can see the back order book was up 21% against last year to £56.9 million. This is made up of two components, £47.4 million of orders that have been contracted but not yet recognised, with flagging that we estimate that about 33% of this balance will be recognised as revenue in 2026. On top of this, there's £9.5 million of annualised support and maintenance revenue. So taken together, we think that the back order provides very good cover for revenue both in 2026 and also in future years. In terms of the revenue that we delivered during the year of £45.4 million, this slide here shows that most of the growth was driven by services, which reflected the increase in the services day rate on the key implementation projects that we generated during the year. At the same time, software revenue has remained robust at £24.4 million and included a higher proportion of Cerillion license revenue, which was partly offset by lower margin third-party license revenue. As I said before, the adjusted EBITDA margin has increased up to 50.9%. This includes the impact of favourable FX, higher day rates on implementation projects, as well as the favourable impact from license revenue mix. Okay, over the slide, in terms of cash generation, the table at the top shows a reconciliation of adjusted EBITDA down to free cash flow. You can see that in the year there was some build in working capital, and that was mainly driven by accrued income, which increased by about £6 million on the prior year. This increase is linked to the way that we recognise the licence revenue. So licence revenue is recognised up front when the software is available for use, but the customers typically pay on a quarterly basis throughout the term of the contract. Hence, when we recognise the licence revenue, accrued income builds up in the balance sheet, which then unwinds over time as the cash comes in. I think it's worth flagging, we do have a very good track record of being paid by our customers. What we're selling is mission critical software, and we do have the ability to turn the software off if the customer doesn't pay, and therefore we do have a very good track record of that accrued income converting into cash over the term of the contract. Finally, the graph at the bottom shows a reconciliation of opening net cash to closing net cash. The key point here is that the free cash that we generated during the year was much higher than the outflows for dividends, the small amount we paid for employee incentive shares and lease payments. So this is the story getting to closing net cash of £34.4 million. In terms of the detailed income statement, a couple of additional points to mention here. Firstly, as Louis said before, we do continue to invest in R&D. So we invested about 17,500 days in R&D over the year, which is up over 30% on the prior year. Of that, we capitalised £1.8 million of development costs, and this balance made up about 70% of the total gross spend. Operating expenses at £16.7 million remained broadly flat with the prior year. So whilst we did continue to invest in heads and payroll inflation, the impact of this was offset by higher capitalisation of development costs, as well as favourable FX. Over the slide to the detailed balance sheet, I think the key point here is that the balance sheet remains incredibly strong. We've still got net cash of £34.4 million. There is no debt. And during the course of the year, there was an increase in net assets of 23%, up to £59.6 million.
Thank you, Andrew. Looking forward again into 26, we're very pleased to see overall unweighted pipeline. This is new customer pipeline increase a bit to 275 million, and our weighted pipeline increase to 65 million. But I think that the most important thing we've been flagging to investors about this pipeline is the quality of the pipeline at the moment and the proximity to closure and maturity of substantial deals. And I think, we do expect to see some traction on at least some of that relatively soon. That's one of the main drivers of confidence in terms of why we think we'll achieve consensus 26 numbers, and why 27 looks good too. So, that is something we've been flagging. Just summing up, Andrew's relayed the numbers. We're very pleased to have hit those new highs again. New orders up 25%, really important in terms of this year and next. And the pipeline I've just spoken about is strong. And we've talked about the financial profile, dividend. All in all, I think we're well positioned for 26, and we're very confident. So, Gareth, back to you.
Would you say that the M&A multiples in the sector are still on the high end? And then a separate question, but I think related, and maybe you can take them together, is how did the multiples of the two competitor acquisitions compare to your own valuation?
So I think that the one that's disclosed is the CSG one. So I think that multiple was about 2.7x EV over sales. I could be wrong, but my memory is it's that sort of order. I think at a EBITDA over sales over revenue multiple, it's around 20ish. So that's a bit lighter than we are. I think someone else will have to help me out with what our current EBITDA over revenue multiple is. But it's sort of in the ballpark. Obviously, we trade on a much higher EV over sales multiple. I mean, we're at around 7 or 8, I think, on EV sales. But that's because of the high margin. The high margins mean that we're not as expensive at a EBITDA multiple level. I should point out that CSG was trading a much lower multiple as a public company because it has much lower margins. I mean, I think 12% EBITDA margin compared to 50%, and was barely growing for the last few years. So that we would expect to see a premium over that.
What's the minimum IRR that you're targeting for your AI-related product developments?
So I think the thing about AI investment is we will see some incremental additional business with existing customers, and the product we're building in AI is licensable. So you need to buy a subscription to use those products and services. Essentially, we're selling them as SaaS products. But this is incremental really to the main. It's not going to be 50% more than you're already paying. We're talking about incremental bits of functionality. And I think the way to think about AI is it's more about staying at the front of the pack and making our product set more attractive than the rest, such that AI is not a reason not to buy Cerillion. We want to be the most flexible, most open, most powerful user of AI in the BSS OSS space, and that's why we're investing the money in it. But it's not going to be something which we double our revenues on, if you see what I mean. It's just going to become, all of the front runners are working on this stuff, and anybody who wants to stay in this business will need to have these features.
A question about actually your personal share sale, Louis. Said your recent £46 million share sale was your first since 2017. How should investors reconcile this significant reduction in your holding with your stated ambition to double the company's size and your long-term conviction in its growth potential?
Yeah, that's a fair question. Well, I mean, to put it in perspective, I reduced the holding by a third, so I still retain 2/3 of it. And I think that, at the end of the day, we do live in an uncertain world. We don't know what's around the corner. Lots of geopolitical uncertainty at the moment. And I've been doing this for 25 years, and at some point, it's just sensible to diversify to some extent out of one main core asset. And I'm sure that you guys on the call would all want to do the same thing with your investments. You would know everything in one stock. And whilst I firmly believe that we will double the size of the company, it's really just about a little bit of diversification. But I have no plans to sell any more stock. I didn't need to sell the stock particularly. It wasn't that there was a particular driver. It was in a way there's never a good time. But it's something that was sort of been on the agenda for a number of years, really. It's just a case of at what point does it make sense, and I'm sure you understand that dynamic.
Your record £47.6 million in new orders contrasts sharply with 3.7% revenue growth, and your 12-month backlog conversion forecast has slowed from 45% to 33%. What gives you confidence to reiterate a goal of doubling the business in 3 to 5 years? And should we expect a material re-acceleration of revenue in FY26, or are longer implementation cycles and capacity constraints the new norm?
Okay, so let me start on that, and then maybe I can hand over to Louis. I mean, clearly, there is a difference between winning orders in the year and recognizing revenue. So yeah, absolutely right. The revenue was up 4% in the year, but orders have been up significantly more, to 25%, up to £47.6 million. So first of all, I mean, the increase in orders has been very helpful because it has meant that the back order book has closed at a record level of £56.9 million. So that was up 21% on the prior year. So that gives us a huge amount of confidence coming into 2026, in that we do have a high level of revenue that has been underpinned both in 26 and in future years. I think it's also right to say that the proportion of the back order that we expect to unwind in 26 is slightly lower than it has been in previous years. We are flagging that of the £47 million, about 33% of that is expected to be recognised as revenue in future years. In 2026, but of course the rest of it will be unwound into future years, which is very positive. Taking a longer outlook in terms of why we continue to feel positive about 2026. If we look at both the unwind of the backlog and we add on the impact of the support and maintenance run rate, and then adding on the impact of indexation, we think that gives us about 50% coverage of analyst consensus in 2026. So we feel that gives us a very good starting point. Now, of course, on top of that, there's a number of things which aren't included in that number. First of all, every year we do get term license renewals coming through. Now, those term license renewals and extensions aren't included in the backlog because our accounting policy is to recognise that license revenue when those renewals and extensions are signed. So we would expect that to give us some boost on top of the sort of the 50% coverage that I've talked about already. On top of that, every year we do get a lot of services revenue, which is upselling to existing customers. And then finally, the amount that is missing on top of that is any impact from new customer wins. So, as Louis was saying before, the prospective customer pipeline is at a record level. The quality of the opportunities has gone up. So, we're feeling very confident about signing new customer contracts in the near-term future, and that should deliver a significant amount of additional revenue on top. So, that is the way that we view prospective revenue for 2026, and that is why at this point in time, we're feeling confident.
Great, thank you. And then the last section, you sort of touched on part of this already, but could you talk a bit about the weighting of revenue growth in 2026 between H1 and H2?
No, absolutely. I mean, it's a good point. So in 2025, we experienced a stronger H2 versus H1, and we are expecting a similar trend in 2026. So we think the first half will be about 45%, with 55% revenue in the second half of the year. And that is really driven by the expected timing of license revenue dropping through. So if we were to sign a new contract, a new customer in the first half, we wouldn't recognize any license revenue in the first half, because it typically takes about 6 months between signing a contract and recognizing revenue. But naturally, therefore we would expect to recognize a bit more license revenue in the second half of the year, for example.
First one is, you mentioned the sales heads increase of 5 people. This is coming off an existing base of how many sales heads?
Around 20.
Okay, so 25% increase. And then another one, talking about diversification, are you comfortable enough with the current customer diversification, or will you try over time to decrease that risk? So,
I mean, we unusually in 25 we had a lot of revenue in 77% of revenue was in Europe. It's normally about half that. I mean, having said that, Europe is by far the most diverse telecoms market in the world, and it has so many different kinds of telcos and lots of rich small countries with multiple telcos, all driven by regulation, which is a good market. But I think we can certainly. I mean, it's interesting. Markets like the Caucasus, not a market we really thought of until recently, but there's a market I spoke about earlier where there is opportunity. We think we can do more in Asia, and we think we can do more in North America than we're doing, and also more in the Middle East. And that's we're sort of targeting those new sales hires at particular regions mainly. So that's very much our strategy, is to develop more presence in a region through putting some more resource on the ground.
And I think just one point for me to add to that, in terms of customer concentration, if you look at it in any one year, it's naturally going to be high, and that really falls out of the way that we recognise the revenue. So to reiterate, we recognise license revenue up front when the software is available for use, but then over the remaining period of the term contract, which is typically 5 years, we would expect the total revenue to be a lot lower than in the first year. So there is naturally a level of concentration towards the start of the contracts, which then falls away. So therefore, moving from one year to the next, you would expect there to be a change in customer concentration, albeit we do have a handful of customers where we have a very good track record of upselling them to them sort of year after year.
Okay, actually, on that point, we have had a couple of questions about revenue recognition policy and looking at a 5-year contract as an example and talking that through. Is there anything else you wanted to say about revenue recognition and the way that you recognise sales across that time frame?
Yeah, so let me just expand on what I just said. So a typical new customer contract is a 5-year term contract. What the customer will see is really 2 components. They'll see an implementation component, which is usually 30 to 40% of the total contract value. That revenue is recognised over time on a percent completion basis, and the typical period, as I said, is 12 to 18 months. The second element that the customer sees is the subscription fee. So this covers everything else in the contract. So the license revenue, support and maintenance, and managed service, and in some instances, third-party hardware and hosting. So looking at the subscription fee, whilst the customer pays the same amount, typically on a quarterly basis, under IFRS 15, we have to strip the amounts out and recognise them slightly differently. So the license revenue is recognised up front when the license is available for use, but the other amounts are recognised on a straight line basis over the course of the term.
Another question on the pipeline, so the sales pipeline. Please, could you give a flavour of the size of potential opportunities in your pipeline, since you say there are some who are much larger than current ones?
Yeah, I mean, it can't be too specific for obvious reasons. But when we say substantial, we mean bigger than the biggest deal we've signed to date. So the biggest deal we signed to date is 25 million as a single deal. But what is true and is important thing to be aware of is that the average size of the prospects in the pipeline has increased quite significantly. And we've seen one of the features of the last 7 or 8 years since IPO is the gradual increase in size of the biggest ever contract win. And that is what really is going to power growth going forward. Someone asked about the 3 to 5 year plan to double again. It's by winning more of these larger telcos, which have a great propensity to generate upsell. That becomes a sort of self-perpetuating cycle. So that is really important.
We've got a question on the US market, just following on from the geographic part of the conversation. Please, can you enlarge on the US market? How is it different to Europe, and what opportunities does it offer?
Well, I think it's different in that it's dominated by a handful of very large telcos like Verizon and AT&T and so on. And so on the one hand, that's a challenge. So our largest competitor, Amdocs, earns about $1 billion a year with AT&T, for example. So are we going to take that business over in the near future? Possibly not this year. Might be a stretch next year. But what we can do is win other business in AT&T, for example, or in Verizon, or in T-Mobile, whatever. There are subsidiary piece of business we could win that are not the main consumer billing for 100 million customers. Around sub brands, MVNO brands, wholesale billing, for example. So it's a whole load of different stuff we can do in those organizations. And those big telcos have multiple VSS, OSS vendors. They're not just none of these large telcos just rely on a single vendor in this space. So I mean, I guess that is one of the major differences. Whereas Europe has lots of smaller telcos because they're nationally based. And I think in general Europe's more dynamic. There are more different types of telcos in Europe. The US has been slow to adopt some of the more interesting models, like the greater diversity of MVNOs and so on. And then of course the other end of the scale, the US has a lot of very small regional players that are sort of 3 counties in North Carolina and 2 in South Carolina, sort of thing, and that's quite a common model. And there's not as much in the middle. There aren't as many mid-sized players, and of course mid-size in that part of the world will still be a large telco in Europe, but there just aren't many of those. So those are the main kind of differences.
Perhaps one for Andrew again. With respect to accrued income and its conversion into cash, have you ever had to write off accrued income or had a customer who didn't pay?
So I think that the first thing to say is we do have a very good track record of being paid. So what we're selling to the customers are mission critical systems. The customer typically can't operate their systems without our software. So that gives us very strong leverage in order to get paid. I think going back in the company's 26-year history now, that remains the case. I think naturally from time to time, given the industry that we operate in, there will be customer disputes occasionally that crop up. In my time here, there has been one instance where there has been a customer dispute. We had in that instance, we did have to write off a small amount of the accrued income. That was several years ago. And we were able to fully manage that. We took the write-off above the line and still were able to generate the very high margins that we have reported.
From your experience, how difficult is it for a customer to switch from a full stack software provider like Cerillion to a new one? Would it be too optimistic to think that as long as you maintain a healthy relationship with a customer for years, it's very unlikely that this happens?
Yeah, it is unlikely. It is hard. I mean, we have pretty much the shortest implementations in the industry, but typically projects with the larger competitors are 3 to 5 years. Typically, it'll take a year at least to choose a vendor. So it's a big long process, and it's hard to move. It's really hard to move. I mean, these are mission critical real time systems, and you know, it's a lot of risk in moving.
Another question on the sales team. Could you provide a bit more color on the new sales hires in terms of which gaps they're filling, whether in terms of region or product type?
In terms of the frontline salespeople, it's targeting particular regions. So, you know, one of these people is covering Middle East, another one's covering that new market in the Caucasus, another one new head of sales in the US. But also on the pre-sales side, we've picked up a couple of good pre-sales guys from one of our competitors in Poland. That helps with the European, you know, deals that we bid on, and you know, some more diverse language skills in France and so on. So yeah, it's a range, but essentially with the frontline salespeople, we're targeting people who have come from competitors with network, knowing a customer base that might be vulnerable, and essentially some level of pipeline, which is much more effective than bringing someone in from an adjacent sector, adjacent vertical, with no network in this vertical. You know, that's a tougher conversion.
Free cash flow to EBITDA has been about 60% over the last 3 years, much lower than in the previous 3. Do you have a target for free cash flow conversion, or failing that, should we expect free cash flow conversion to improve going forward?
I mean, I think the important point here is, yeah, the free cash flow conversion is tied to the way that we recognise our license revenue. So clearly, you know, when we recognise the license revenue up front in a typical 5-year term, but the customer pays the cash over the course of the term, you know, that leads to accrued income being recognised due to the disparity between recognising the revenue and the profit and receiving the cash. I think, you know, the important thing is we do have a good track record of being paid. I think, you know, as we plan to continue to grow the business, you know, that would impact cash conversion, because you would expect, you know, to be recognising revenue at a faster rate than receiving cash from previous contracts. You know, if we were a steady state business, I think, you know, cash conversion would clearly be much better. But we do plan to continue growing the business, and therefore I think it's fair to assume that, you know, that there would be an impact on cash conversion in future years. However, you know, I think the important thing to note is that we do have a very good track record of being paid, and there are no amounts in accrued income at the moment where we foresee risk that we're not going to be paid. So, you know, we think it's just a matter of time before that accrued income does turn into cash.
If a new customer adopts only a few of your modules from your entire suite, what would be your expectation of them adopting the rest of the suite over, say, the next 5 years?
It's very difficult to give a general answer on that. It's fair to say that most customers acquire most of the modules up front. You know, perhaps sometimes customers, for example, would acquire all our main modules, but wouldn't buy the charging module because maybe their network equipment vendor is doing that for them, and they want to continue with that. And quite often, after a few years, customers will then buy the charging from us as well, because it's much more powerful to have all that fully integrated with the rest of the suite. But apologies, but it is hard to give a general answer. But suffice to say that most customers buy most of the modules.
Just before we finish, I'll hand back to Louis for any final closing remarks. Louis.
Thank you, Gareth. I'd just like to reiterate that thanks to you all for attending and taking your time. Really, my summary is, you know, we're very confident about 26 and beyond, and you know, we think there's a lot of room for growth here, and you know, long way to go, lots to achieve. Thank you very much.